Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of cryptocurrency regulation, balancing innovation, security, and global challenges. Asia's approach to crypto regulation. Asia offers a diverse regulatory landscape, ranging from outright bans to progressive adoption. Let's break down how major players in the region are handling cryptocurrencies. China. China has taken an aggressive stance against cryptocurrencies. In 2021, the government banned crypto mining and declared all cryptocurrency transactions illegal, citing concerns about financial stability and environmental impact. However, China promotes its digital yuan, a government-issued central bank digital currency, CBDC, as a controlled alternative to decentralized crypto. Japan. Japan is one of the few nations with clear, forward-thinking crypto regulations. It recognizes Bitcoin and Ethereum as legal property under the Payment Services Act. Crypto exchanges must register with regulatory authorities and comply with transparency and anti-laundering laws. Japan's robust rules have turned it into a global crypto hub. South Korea. South Korea strikes a balance between regulation and innovation. In recent years, the government introduced stricter anti-money laundering laws and required exchanges to partner with licensed banks for real name account verification. These measures aim to combat money laundering while integrating crypto more widely into the economy. Asia's approach varies widely, reflecting the economic priorities and political values of each country. While some nations prioritize control, others are leaning into innovation to stay competitive. Developing nations and cryptocurrencies. In developing nations, cryptocurrencies are often seen as a lifeline. They provide access to financial systems for underbanked populations and protect savings during periods of inflation or political instability. However, regulation remains a challenge. Adoption booms without guardrails. Countries like Nigeria and Venezuela have seen skyrocketing crypto adoption driven by economic hardships. Bitcoin and stablecoins act as both stores of value and practical payment methods. Yet, weak regulatory frameworks leave users vulnerable to fraud and market downturns. Regulatory ambiguity. Many developing nations lack formal guidelines for crypto. Governments may oscillate between cracking down and exploring ways to capitalize on blockchain technology. For instance, El Salvador made Bitcoin legal tender in 2021, but its long-term success remains uncertain. Infrastructure hurdles. In regions with limited internet access or technical infrastructure, the rise of cryptocurrencies faces natural limitations. Education about how to use and secure crypto assets also lags behind its rapid adoption. Despite these obstacles, the potential for cryptocurrencies to empower individuals in developing economies remains clear. Policymakers face the tough task of balancing consumer protection with fostering an environment where this technology can thrive. Cryptocurrency regulation across the globe reflects the diversity of priorities and challenges unique to each region. From the fragmented policies of the US to the harmonized frameworks emerging in the EU, the world is searching for ways to embrace innovation while protecting consumers and markets. The role of technology in cryptocurrency regulation. Technology plays an essential role in shaping cryptocurrency regulation. With digital assets operating in decentralized and often anonymous networks, using advanced tools and systems has become key to enforcing compliance and preventing misuse. At its core, technology bridges the gap between innovation and accountability, making it possible to monitor activity without stifling growth. Here's how it's contributing to effective cryptocurrency regulation today. Blockchain analysis tools. Blockchain analysis tools have become the backbone of regulatory oversight in the cryptocurrency world. These tools allow regulators, businesses, and law enforcement agencies to examine blockchain data in unprecedented detail. Because blockchain transactions are immutable and publicly recorded, analysis software can comb through these records to identify patterns, flag suspicious activity, and trace the movement of funds. Here's how they contribute to transparency and anti-money laundering (AML) efforts. Tracing transactions. Tools like blockchain explorers make it easier to follow the flow of cryptocurrency from one wallet to another. While crypto wallets themselves don't show the owner's identity, repeated patterns and forensic techniques can link these wallets to real-world individuals or organizations. Identifying red flags. Advanced analytics software can detect unusual behavior, such as transactions just beneath reporting thresholds or rapid movement in high-risk jurisdictions. These red flags alert regulators to potential money laundering or fraud. Monitoring compliance. Companies offering crypto services rely on these tools to ensure they comply with AML regulations. For example, many exchanges use blockchain analysis software to screen addresses against blacklists of known illicit actors or sanctioned entities. By making this kind of transparency possible, blockchain analysis tools strike a strong balance. They respect decentralization while allowing for regulatory oversight, ensuring cryptocurrencies can't be a safe haven for illegal activity. It's like turning on a flashlight in a dark room. Suddenly, hidden details are much easier to see, making those spaces safer for everyone to operate in. Smart contracts and automated compliance. Smart contracts represent the next step in using technology to simplify and enforce compliance. These self-executing contracts are powered by blockchain networks and operate based on predefined rules coded directly into them. Once those conditions are met, the contract performs actions automatically, without requiring manual intervention from a third party. So, how could smart contracts revolutionize regulatory enforcement? Embedded compliance. Imagine a financial transaction subject to tax or reporting requirements. A smart contract could include those rules as part of its code. For example, a smart contract could automatically withhold taxes during a transaction and send them to the appropriate government agency. Everything is tracked, recorded, and executed instantly, eliminating human error. Real-time reporting. Instead of relying on manual filings, smart contracts can generate audit trails in real time. Regulators can access these records instantly, giving them a clear picture of compliance without delays or discrepancies. Preventing unauthorized activity. Smart contracts can include built-in restrictions for specific wallet addresses or transaction types. For instance, if a wallet is flagged as being involved in illicit activity, smart contracts could prevent funds from being sent to or from that wallet. It's like having a built-in referee for crypto transactions. The rules are clear, impartial, and automatically enforced, removing much of the guesswork and loopholes that traditional systems often struggle with. This makes the enforcement process fairer and faster for everyone involved. By combining blockchain analysis tools and smart contracts, regulators and industry players can work toward a more transparent and reliable cryptocurrency ecosystem. These technologies aren't just about catching bad actors, they're about creating a system where trust is baked into the foundation, making cryptocurrencies safer and more sustainable for the future. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.